Hey there, this is Brad Gill with NextHome Lifestyles, here with a quick market update for September 2019. School's back in session and summer is over, and if you're thinking about buying or selling a home this fall, then be sure to stick around to find out what the market trends are showing. Now let's start off discussing what's been top of mind lately, like how an impending recession may lead to another housing crisis like we saw back in 2008. Well, let's take this opportunity to dispel these fears. Although a slowdown in the economy in 2020 is being predicted, this time around, housing will not be the cause of the slowdown, and most likely, home values will actually continue to trend upward. In fact, home values actually increased in 3 out of the last 5 recessions and decreased by less than 2% in the 4th. Remember, the main reason we saw a major housing crash during the last recession in 2008 was because the housing market and the mortgage meltdown caused it. For more information about this topic, please check out my recent video, Does a Looming Recession Equate to a Housing Crisis? Looking at national housing prices, if a major housing crash were on the horizon, wouldn't you expect to see prices falling from last year? Well, we're actually seeing good growth across the U.S., as August reported that home prices grew 4.99% nationally compared to last year. Drilling down closer to home, in the Pacific region of the country, our year-over-year home appreciation reported to be 4.4%, and even closer to home, statewide for California, we saw a little less price growth, but still a 4.2% increase. With these positive numbers, so far it appears that our economy is still strong enough to support growing homeownership rates. And looking forward, even in the eyes of a slowing economy, the national housing market is actually expected to gain 5.2% appreciation through next year, with California expected to see as much as an 8.2% increase in prices year over year as well. So what's causing all the positive price growth? Well, the Federal Reserve is actually combating our recession woes by continuing to ease interest rates, which is helping long-term mortgage rates stay low, even recently hitting historic lows not seen since 2016. This is absolutely great news, as lower mortgage rates help increase purchase power and affordability, something which Bay Area residents can really celebrate. Now let's take a look at some numbers here in San Jose. Total active inventory was down again for the month of August, with 1,126 total homes available, a decline of 8% from July. 777 of these were actually new listings, which were also down, but only slightly from last month. And for buyer demand, with mortgage rates at near historic lows, we'd hope to see demand stabilizing. So with August reporting a slight decline of only 2% from last month, with 676 total closed sales and a total of 627 homes receiving a contract, just a little down from last month, I think we are seeing just that. Plus, Freddie Mac's chief economist even recently reported that home buyers flocked to lenders in August, with purchase applications up 15% from a year ago. So as long as pending sales, which are being driven by lower rates and softening housing prices, continue to keep up with new listings, we should continue to see a very stable and balanced market around here. Looking at the median days that a property is on the market before receiving a contract, the month of August is up slightly to 19 days, but overall anything less than 30 days is still a great market. The median sales to list price ratio is also slightly down, reporting at 100.2% for the month of August, meaning homes are selling just above the asking price. And our median home sales price this month is continuing on a slight downward trend as well, dipping to $949,500, down 5% from last month and down 7.5% from its peak earlier this year in June. But our prices are still up 2.2% from the beginning of the year. So, have we reached a price plateau? Maybe. The median sales price has been holding pretty steady since last fall. So, looking forward, what are the market trends really telling us? Well, the best indicator of what to expect comes from looking at the current month's worth of supply, which measures how quickly new listings are being absorbed by the current level of buyer demand, which for August is just under 2 months. As you may recall, anything under 6 months worth of supply is still considered a seller's market. It may not exactly feel like a seller's market, especially here in the Bay Area, as home sellers have unbelievably become accustomed to homes selling at average 10 to 15% above their asking prices within days of being listed. But that's because we're finally settling into a more balanced market. So, for anyone looking to sell this fall, conditions are still in your favor, but you must adjust your expectations, as the market is just not as crazy as it was a year ago. Your home must be priced appropriately if you wish to generate the interest levels necessary to sell quickly and at a great price. Markets always change, and it always seems to incite fear since things stop behaving exactly how they have been. And with negative headlines touting a looming recession, it's no wonder why many home buyers are sitting on the sideline waiting to see what happens. Well, listen up, home buyers. This is your wake-up call. Don't miss the opportunity to lock in a very low housing payment at a very reasonable price. The market hasn't looked this good for first-time home buyers, move-up buyers in a long time. So if you're still considering a move into your first home or to your next home, and you haven't updated your pre-approval in a few months, it's a great time to find out just how these low rates have improved your purchase power. Thanks for tuning in, and remember, a successful real estate experience always starts with the right strategy. Until next time, thanks again for tuning in.